When I mention the word accounting, you'll actually see some people wince. But that's one of the things I love about QuickBooks. While you certainly can know a lot about bookkeeping and accounting, and you can use those and see how they're working in QuickBooks, the good news is you don't have to know anything about accounting. QuickBooks takes care of all of that stuff in the background. Now, as an instructor, I wouldn't be much of an instructor if I didn't tell you a little bit of theory behind what's actually going on the computer as you do the clicks. So what we'll do in this chapter is take a look at some accounting primers, Accounting 101 if you will, and then we'll move right into the chart of accounts and show you how to make it work in QuickBooks itself. Sometimes I feel like I say it a little bit too much, but I need to remind you that QuickBooks does not require a lot of accounting knowledge. Now, I can say that to you because I actually have limited formal background in accounting or bookkeeping, but that's actually a good thing. I've been able to successfully run my company for more than 15 years using QuickBooks without formal accounting knowledge. I hope that makes you feel a little bit better. But with that said, you also do have to understand a little bit about accounting, what it is, what it does, in order to use accounting software, and that's what QuickBooks is. So we'll get through a little bit of what I like to call Accounting 101, and then we'll get on to working with our actual accounts in QuickBooks. The first term you should be aware of is something called GAAP, G-A-A-P. It stands for Generally Accepted Accounting Principles. And it actually can be very complicated, like all of accounting could be, but the term refers to the standard framework, if you will, or guidelines for financial accounting. It's used regardless of the type or size of business that you have, and that's what makes it great. It includes the standards, conventions, and rules, if you will, that are followed in recording and summarizing all of your transactions, whether it's income, sales, assets, or any of the other things related to the financial success of your business. Those things may be important to you, and you may have them all stored in your head, but if you ever go to the bank and want to have a loan or something else like that, you're going to need to have some financial statements, and that's when GAAP comes into play. Because financial statements like the profit and loss or a balance sheet are directly related to following these principles. They're intended to make everybody's statements objective rather than subjective. You know, I could go and say, hey, my business is doing great, but a banker doesn't know what that means. By using GAAP, everybody's on the same playing field, if you will. GAAP remains fairly stable as well, while tax laws change significantly from year to year. And if you've done your own taxes, you know that every year there are all kinds of changes you have to keep track of. Well, those changes need to be tracked, but as far as the accounting itself goes, it remains fairly stable thanks to GAAP. So again, the most important thing about this is that they're universally understood and interpreted by anybody, regardless of their business, regardless of what exact type of transactions they have. GAAP gives us a consistency that we're looking for. The second term that you need to be aware of is double entry bookkeeping. That also sounds a little bit ominous. And it's been around, though, for almost forever. Actually, about the 13th century in Venice, I believe, is when they began using double entry bookkeeping. It basically says that if you credit one account, you must also debit another account. It's basically a means of ensuring that everything happens and is recorded correctly. I like to think of it, because I have a little bit of a science background, is like matter. If you've ever heard that there is only a finite amount of matter in the universe, so when things are created, something else is destroyed, that's basically the same thing that we're talking about here with money. Money is never lost. It's simply transferred from one account to another. So, as an example, if you had a sale and you sold a product, you would be getting cash and increasing the amount in the cash account while you're removing something from your inventory account. Between the two, they balance out. The other term that you'll often hear with double entry accounting is, of course, debit and credit, but we're trying to stay away from all of that technical language. Why do you care about GAAP and double entry bookkeeping? Well, because the first thing you need to worry about in QuickBooks is setting up your chart of accounts. The chart of accounts follows the GAAP processes, and it also uses double entry bookkeeping. The good news is most of it's behind the scenes. Again, we'll give you just a little bit of information without trying to give you too much detail. The chart of accounts basically has two different types of balances. There are temporary balances and permanent balances. Temporary balances reset each period, and they actually appear on your P&L or your profit and loss. So if I say, what's my P&L for the first quarter of the year, those are temporary. An example of that is the cost of goods sold. How much did it actually cost me to buy the inventory that I ended up selling in that same period? Permanent accounts, on the other hand, accumulate over the entire life of the company. They never zero out, and these show up on the balance sheet. While the P&L is temporary or good for a certain period, the balance sheet shows the longevity of the company over its entire lifetime. An example of this would be any shareholder equity, monies that the shareholders put into the company. The accounts can be created in QuickBooks in one of three basic ways. They're created kind of behind the scenes when you do the Easy Step interview, or if you do the company file setup on your own, you will be creating these as well. We also can create our own accounts in the chart of accounts, and some of them are even created automatically as we do certain tasks within QuickBooks. Within the chart of accounts, we have different types of accounts. And again, these may seem a little overwhelming, but they're not really that scary once you understand what they are. Naturally, we mostly understand expenses and income. Expenses are things that we spend, income is things that we make. Hopefully, we have more income than expenses. That's kind of the balancing act. But we come into a couple of other terms when we're talking about income, and that is, what is the cost of goods sold, and how does that affect our gross profit? Let's take an example. If I purchased an item for $50 and I sold it for $100, the income I made, the $100, minus the cost of the good, the $50, would equal my gross profit, which is also $50. You can see why this is important, because you could be selling thousands or tens of thousands of dollars worth of goods, but if they were costing you just as much or more to purchase than you got from selling them, then obviously you're not profitable. The next thing we can talk about are assets. Assets, of course, are things that benefit the business, and there are two types, current and fixed. Basically, anytime you hear a current or fixed, as with assets and liabilities, usually a year is the cutoff point. So if I have an asset that I plan on getting rid of within the next 12 months, it's a current asset. Things like cash, your accounts receivable, you hope that people are paying their bills, and any inventory, because we don't want to hold on to inventory very long either. On the other hand, we have fixed assets, things like equipment, furniture, or vehicles. These are things that I usually intend to keep longer than 1 year. Now, if there's some things that kind of sit on the border of those, you can choose between making it a current or fixed asset, but that's kind of an accounting decision. Some people might consider computers to be a current asset. As I said, that gets into a whole different thing about depreciation, which we're not going to talk about here. So let's stick with just knowing that current means I'm going to turn it over in less than 12 months, and fixed means it's something longer than 12 months. If we then go and look at the other side, we have liabilities the same way. For example, we have certain accounts or bills that we have to pay. We have to pay payroll, and we have to pay sales tax that we've collected. So those are considered current liabilities. We also have longer-term liabilities or fixed liabilities. For example, if I have a 5-year lease on my office space or a mortgage on a building I'm buying. Lastly, and perhaps most confusingly, we have equity and retained earnings. Now, these can be very complicated, and as I said, we're really not going to give you an accounting class here. If you need to deal with these, either you'll be educated on it on your own, or you'll have an accountant helping you, preferably the latter. What this basically is the value of business to the owners. Equity is kind of interesting, and basically it means and includes money that we've contributed to the business. So if I go ahead and invest $10,000 in my business, that would be equity that I've put into the business. Retained earning is something that tracks all the income or loss since the start of the business. And if you think about that, that's where it really gets complicated. Retained earnings and owner's equity are automatically added to every new chart of accounts. And QuickBooks automatically transfers all of your net profits, or losses if you have them, to the retained earnings account at the end of the year, part of closing the books. So with that said, you now know that we have different types of accounts in QuickBooks: expenses, income, assets and liabilities, and then the equity and retained earnings accounts.